There's a pattern in financial markets that has destroyed three massive institutions in the last 26 years. And right now, in 2025, JPMorgan Chase, America's largest bank, is following that exact same pattern, stage by stage, derivative by derivative, almost like they're reading from a script that ended in catastrophe every single time before. In 1998, long-term capital management was the most sophisticated hedge fund on earth. Two Nobel Prize winners, 25-to-1 leverage, $1.25 trillion in derivatives. Their models said they'd solved risk. Within 63 days, they collapsed. The Federal Reserve had to orchestrate a $3.65 billion private bailout to prevent the entire financial system from imploding. In 2008, Bear Stearns was an 85-year-old institution, survived the Great Depression, 35-to-1 leverage, $13.4 trillion in derivatives. Their CEO called it the best risk management on Wall Street. Within 7 days, the firm ceased to exist. JPMorgan bought the corpse for $10 a share. In 2008, AIG held a AAA credit rating, $527 billion in credit default swaps, insurance on bonds that could never default. Within 48 hours of a credit downgrade, the company faced bankruptcy. Taxpayers paid $182 billion, 3 times, 3 institutions, 3 complete collapses, all following the exact same 5-stage mathematical sequence. And here's what should terrify you. JPMorgan Chase now holds $54 trillion in derivatives. That's 13 times the entire United States economy. 26% of every derivative in the American banking system sits on one balance sheet. The Office of the Comptroller says this is safe. Jamie Dimon calls it hedged and matched. Regulators point to stress tests. Until you see what happened in June 2024, the Federal Reserve and FDIC flunked JP Morgan's crisis plan for the second time in 8 years. The verdict: the bank cannot demonstrate the ability to manage its derivative book in a stressed scenario, cannot calculate capital needs in a crisis, cannot prove it can wind down without destroying markets. Translation: if the next dislocation hits, nobody, including JP Morgan itself, knows how to stop what comes next. This is the story of how financial giants die, why they always think they're different, and why the math says $54 trillion in derivatives doesn't stay theoretical forever. Let me show you what happens when the numbers stop making sense. The conventional wisdom says modern derivatives are safe. Banks argue that $54 trillion is just notional value, reference numbers for contracts, not actual money at risk. Regulators point to stress tests and capital requirements. Jamie Dimon assures investors the bank's derivative book is matched and hedged. The Office of the Comptroller of the Currency reports that net current credit exposure is only $251 billion across all U.S. banks, a manageable 0.1% of the notional amount. It all sounds reassuring, until you look at what happened to the last 3 giants who said the same thing. Here's what the data actually shows. As of the first quarter of 2024, just 4 U.S. banks hold 87.6% of the entire banking industry's $206.1 trillion in derivatives. JP Morgan alone controls $54 trillion, 26% of the total. That includes $3.3 trillion in equity derivatives, representing 62% of all stock derivatives held by America's 4,914 federally insured banks. And here's the critical detail. 74% of those equity derivatives are over-the-counter contracts, not centrally cleared, meaning they're largely invisible to regulators until something goes wrong. The concentration is staggering. $20.8 trillion of these contracts have maturities exceeding 5 years. Interest rate derivatives alone account for $44 trillion, 89% of JP Morgan's book. If interest rates move unexpectedly, if counterparties fail to meet collateral calls, if liquidity evaporates in a crisis, the netting assumptions collapse. The notional becomes real, and the matched book becomes a death spiral. This isn't theoretical. It's happened before, 3 times, 3 different decades, 3 different market conditions, but the same sequence. Stage 1, excessive leverage built on derivative complexity. Stage 2, sudden market dislocation that models didn't predict. Stage 3, Collateral calls cascade faster than liquidity can be raised. Stage 4, counterparty panic triggers withdrawal of funding. Stage 5, systemic contagion or government bailout. Long-term capital management, 1998. Nobel Prize winners, 25-to-1 leverage, $1.25 trillion in derivatives. Collapsed in 63 days. Bear Stearns, 2008. 85-year-old institution, 35-to-1 leverage, $13.4 trillion in derivatives. Collapsed in 7 days. AIG, 2008. Insurance giant, AAA rated, $527 billion in credit default swaps. Collapsed in 48 hours. Taxpayers paid $182 billion. JPMorgan Chase, 2024, $54 trillion in derivatives, $4 trillion in total assets, 13.5 to 1 implied leverage on derivative exposure. Still standing, still confident, still saying this time is different. The pattern doesn't repeat, but it rhymes with perfect pitch. September 1998. Long-term capital management sits at the bleeding edge of financial engineering. Founded in 1994 by John Meriwether, the legendary Salomon Brothers bond trader, LTCM attracts 2 future Nobel Prize winners in economics, Myron Scholes and Robert Merton. The fund promises to profit from tiny price discrepancies between similar securities, convergence trades, using sophisticated models to find arbitrage opportunities invisible to competitors. Investors pay $10 million each just to get in the door. The fund delivers 43% returns in 1995, 41% in 1996. By early 1998, LTCM manages $4.8 billion in equity capital. But to make money on tiny spreads, often just a few basis points, LTCM needs massive positions. At the beginning of 1998, the fund holds $125 billion in assets on $4.8 billion in equity, 26-to-1 leverage. The derivative exposure dwarfs even that. LTCM holds over $1.25 trillion. Notional in derivative contracts, $500 billion in futures, $750 billion in swaps, $150 billion in options, and other over-the-counter derivatives. Many of these positions represent more than 5% of open interest in their markets, some above 10%. The notional to equity ratio is 260 to 1. The models say this is safe. Positions are market neutral. Convergence trades will self-correct. Value at risk models show minimal downside. What the models don't account for, everyone else on Wall Street is running the same trades. August 1998. Russia devalues the ruble and defaults on its sovereign debt. Markets panic. Investors flee to safety. But instead of narrowing the spreads LTCM is betting on, between on-the-run and off-the-run U.S. Treasuries, between European and Japanese government bonds, between corporate and sovereign debt, explode wider. In a single month, LTCM loses $1.8 billion. The fund's capital base collapses from $4.1 billion to $2.3 billion. Losses accelerate. LTCM's massive positions mean it can't exit without moving markets. As the fund tries to reduce exposure, prices move against them. By mid-September, the fund's equity is down to $1 billion. The leverage ratio climbs to 100 to 1. Counterparties demand additional collateral. Prime broker Bear Stearns requires LTCM to collateralize potential settlement exposures, draining what little liquidity remains. September 21st, 1998. LTCM's repo and over-the-counter derivatives counterparties start calling for maximum collateral through daily mark-to-market valuations. Previously flexible credit arrangements become rigid. The fund faces 20,000 outstanding transactions across multiple counterparties. Without new liquidity, LTCM will default within 48 hours. September 23, 1998. Federal Reserve President William McDonough orchestrates an emergency rescue. 14 Wall Street firms inject $3.65 billion, taking 90% of LTCM's equity. The Fed doesn't lend any of its own money, but coordinates the private bailout to prevent what Fed Chairman Alan Greenspan later calls fire sale liquidations, that could severely impair market functioning. The lesson: LTCM didn't fail because its trades were wrong. It failed because everyone else was running the same trades, and when the crisis hit, there were no buyers. Leverage turned paper losses into existential threats overnight. The firm had $4.8 billion in equity and $1.25 trillion in derivatives. The notional became real. The math was perfect. Until it wasn't. By fiscal year-end 2007, Bear Stearns held $395 billion in assets against $11.1 billion in equity, a 35.6-to-1 leverage ratio. Its derivative notional $13.4 trillion. The firm held over $28 billion in Level 3 assets, illiquid, model price securities, against that $11.1 billion equity cushion. A mere 3% decline in asset values would wipe out equity entirely. Bear Stearns assured investors this was fine. The models said so. June 2007. Two Bear Stearns hedge funds collapse, holding $9.7 billion in borrowed money against $900 million in actual investment. Both funds are loaded with subprime mortgage derivatives, CDOs, CDO squared, synthetic CDOs. When the funds declare bankruptcy in July, counterparties realize Bear's exposure is far greater than disclosed. The subprime fund had a 10-to-1 leverage ratio. The enhanced leverage fund operated at higher multiples. Investor losses, $1.8 billion. March 2008. Mortgage-backed securities continue plummeting. Counterparties start refusing Bear's derivative trades. On March 11th, Goldman Sachs emails hedge fund clients that it will no longer step in for them on Bear derivatives deals, a public declaration that Bear is too risky. Hedge funds that use Bear as their prime broker start withdrawing. Between March 10th and March 13th, Bear's cash position collapses from $18 billion to $2 billion. Repo lenders refuse to roll over overnight funding, even against Treasury collateral. Derivatives counterparties demand maximum collateral calls. Prime brokerage clients pull $25 billion in assets. The bank run is silent but total. March 16, 2008. Bear Stearns agrees to be acquired by JPMorgan Chase for $2 per share, later raised to $10, backed by a $29 billion Federal Reserve loan. 6 days earlier, Bear's stock traded at $70. A year earlier, $172. The 85-year-old institution ceases to exist. The Federal Reserve's intervention breaks precedent. It's the first time the Fed has provided emergency funding to a non-bank institution since the Great Depression. American International Group operates as an insurance giant with $1.06 trillion in assets. Through its London-based subsidiary AIG Financial Products, the firm writes credit default swaps on $527 billion notional, essentially insurance on bonds and mortgage-backed securities. Of that, $78 billion covers super senior tranches of multi-sector collateralized debt obligations, much of it tied to subprime mortgages. All are rated AAA, the probability of default on AAA securities, less than 0.1% per year. AIG doesn't hedge these positions. It runs a one-way book, collecting premiums. 2008. Subprime mortgage defaults cascade. The AAA tranches AIG insured start losing value. By June 30th, 2008, AIG has written credit protection on $411 billion net notional, including $55.1 billion on subprime CDO tranches. Mark-to-market losses accumulate $11.5 billion by year-end 2007, rising to $26.2 billion by mid-2008. As CDO values decline, AIG's counterparties demand collateral under the terms of the credit default swaps. By February 2008, AIG has posted $5.3 billion. By August, $16.5 billion. By November, $37.3 billion. The capital drain is relentless. September 15, 2008, Standard & Poor's downgrades AIG's credit rating below AA-. The downgrade triggers automatic collateral calls. AIG suddenly owes counterparties an additional $14.5 billion. The firm has no cash. Counterparties refuse to extend credit. The company faces bankruptcy within 48 hours. September 16, 2008. The Federal Reserve provides an $85 billion emergency loan, taking 79.9% equity in AIG. By November, the total commitment reaches $182 billion. Of the first $90 billion, $60 billion flows directly through AIG to its derivative counterparties, Goldman Sachs, Société Générale, Deutsche Bank, Merrill Lynch. Taxpayers absorb the losses. Two institutions, two different business models, same sequence. Bear Stearns, 35-to-1 leverage, $13.4 trillion derivatives collapsed in 7 days. AIG, $527 billion derivatives AAA rated collapsed in 48 hours. Different decades, different triggers, identical pattern. After 3 catastrophes, the mechanism is clear. It's not random. It's not a perfect storm or tail risk event. It's a deterministic system that unfolds with precision once triggered. Here's how the derivative death spiral works. Stage 1. Concentration plus complexity plus leverage. A financial institution builds massive derivative positions. The notional amounts vastly exceed equity capital. The bank claims these are hedged or matched. Derivatives are paired with offsetting positions. Net exposure appears small. Regulators look at net current credit exposure and see manageable numbers, 0.1% of notional. What they miss: concentration risk, liquidity risk, correlation risk. When everyone runs the same hedges, the diversification illusion shatters. The numbers: LTCM had 260-to-1 notional to equity leverage. Bear Stearns, 1,200-to-1. AIG's notional was 495-to-1. JPMorgan today, $54 trillion notional on $344 billion equity, 157-to-1. Stage 2. The sudden dislocation. A market event occurs that the models didn't predict. Russian default, subprime mortgage collapse, a pandemic, a geopolitical shock. Correlations that were supposed to remain stable break down. Spreads that were supposed to converge diverge violently. Volatility spikes. The VIX surges above 30. Markets that are supposed to be liquid freeze. The trigger doesn't have to be large. Russia's 1998 default was a $40 billion economy. The subprime market in 2007 was $1.3 trillion. But when leverage is extreme, small shocks propagate exponentially. Stage 3. The collateral call cascade. As positions move against the institution, counterparties demand collateral. Daily mark-to-market valuations become contentious. Previously flexible credit terms turn rigid. The institution must post billions in cash or securities. But there's a problem. The firm is already leveraged to the hilt. Selling assets to raise collateral moves prices further, triggering additional margin calls. It's a doom loop. Cash drains faster than it can be raised. The numbers are brutal. A 5% move in a $1 trillion position requires $50 billion in collateral. If you have $10 billion in liquid reserves, you default before lunch. Stage 4. The liquidity death spiral. Counterparties smell blood. Prime brokers refuse to roll overnight funding. Repo lenders demand higher haircuts or walk away entirely. Derivatives counterparties unwind positions, refusing to take on new trades. Hedge fund clients withdraw assets. The bank run is silent but total. Credit rating agencies downgrade the firm, triggering automatic collateral provisions in thousands of contracts. What was a liquidity crisis becomes a solvency crisis. The timeline compresses. LTCM had 63 days from peak to bailout. Bear Stearns, 7 days. AIG, 48 hours. Stage 5. Systemic contagion or extinction. The institution faces 2 paths: government intervention or collapse. If regulators determine the firm is too big to fail or too interconnected to fail, taxpayers fund the bailout. If not, forced liquidation crashes markets and counterparty losses propagate through the system. Either way, the damage is done. The next institution in line watches, concludes we're different, and increases leverage. Once stage 3 begins, the remaining stages are mechanical. There's no exit. You can't sell $13 trillion in positions into a panicked market. You can't raise $50 billion in collateral overnight when everyone knows you're desperate. The models assume orderly markets and rational actors. Crises are defined by their absence. As of the first quarter of 2024, JPMorgan Chase Bank holds $54 trillion in derivative notional. That's $54,000 billion. To put that in context, U.S. GDP is $28 trillion. The entire U.S. federal debt is $34 trillion. JP Morgan's derivative book is nearly twice the size of the American economy. The concentration is staggering. Of the $206.1 trillion in total U.S. bank derivatives, JP Morgan holds 26%. Interest rate derivatives, $44 trillion, 89% of its book. Equity derivatives, $3.3 trillion, 62% of all bank-held stock derivatives. Credit derivatives, a significant but opaque portion. Foreign exchange, over $5 trillion. The bank has $344.8 billion in equity capital and $4 trillion in total assets. The implied leverage on derivative exposure, 13.5 to 1 against total assets, 157 to 1 against equity. Stage 1 is complete. Concentration plus complexity plus leverage. The concentration check is obvious. JP Morgan dominates U.S. derivative markets to a degree that LTCM, Bear Stearns, and AIG never approached. The OCC's first quarter 2024 report shows 4 banks control 87.6% of all derivatives, with JP Morgan alone representing more than a quarter of the total. The complexity check is complete. 74% of JP Morgan's $3.3 trillion in equity derivatives are over-the-counter contracts, not centrally cleared. These are bilateral agreements, opaque, model-priced, difficult to unwind in stressed markets. The bank's own disclosures show $20.8 trillion in derivative contracts with maturities exceeding 5 years. That's a long time to bet on stability. The leverage check is masked by netting. Gross positive fair value across all U.S. banks is $2.1 trillion, but after netting agreements, net current credit exposure drops to $251 billion. Regulators call this proof of safety. History calls it an illusion. Netting assumes counterparties honor contracts in a crisis. LTCM had netting agreements. Bear Stearns had netting agreements. AIG had netting agreements. When panic hits, counterparties break agreements, unwind positions, and run. Stage 2 is pending. The trigger hasn't occurred yet, but the fragility is structural. $44 trillion in interest rate derivatives when the Federal Reserve has demonstrated willingness to move rates violently to control inflation. A 1% unexpected move in rates could trigger margin calls measured in tens of billions. The yield curve has already inverted twice in 3 years, a historically reliable recession indicator. Equity markets trade at valuations not seen since the 2000 dot-com peak. The S&P 500's Shiller P/E ratio exceeds 35, territory reached only 3 times in history, all preceding crashes. JP Morgan holds $3.3 trillion in equity derivatives. How many of those are written options, selling volatility, collecting premium? When the market breaks, who's on the other side? The geopolitical risks multiply. U.S.-China tensions, Middle East instability, European banking stress, commercial real estate distress, the unrealized losses sitting on bank balance sheets after the 2022 rate shock. Any one of these could be the match that lights the fuse. Stages 3 through 5 are waiting. The Office of the Comptroller of the Currency tries to provide assurance. The notional amount significantly exceeds, in the bank's view, the possible losses that could arise from such transactions. But in June 2024, the Federal Reserve and FDIC jointly flunked JP Morgan Chase on its living will, the plan for winding down operations in bankruptcy. For the second time in 8 years, regulators told CEO Jamie Dimon the bank cannot calculate its capital needs in a crisis and cannot demonstrate the ability to manage derivatives in a stressed scenario. Translation: if stage 3 triggers, no one, including JPMorgan itself, knows how to stop the cascade. 3 institutions have traveled this path. Each time, the pattern unfolded exactly as predicted. Each time, regulators were blindsided. Each time, executives insisted their situation was unique. LTCM had Nobel Prize winners and the most sophisticated models in finance. Bear Stearns had survived 85 years, including the Great Depression. AIG held a AAA credit rating and was deemed the gold standard of insurance companies. JPMorgan Chase today holds $54 trillion in derivatives, 40% more than the entire 2008 financial crisis peak of $182 trillion across the system. The concentration is higher, the complexity is greater, the interconnection is tighter. 4 banks control 88% of the market. The only question that matters is this time different? The pattern says otherwise. The dynamics of leverage haven't changed. The physics of panic haven't evolved. The mechanics of liquidity spirals remain constant. Markets have collapsed for 400 years, from tulip bulbs to mortgage bonds. Each time, the architects swore they'd solved the problem. Each time, they were leveraged to the hilt when the music stopped. JPMorgan sits at stage 1, waiting for stage 2. The derivatives are in place. The leverage is structural. The concentration is unprecedented. The netting agreements assume rational counterparties in irrational markets. The living will can't demonstrate wind-down capability. When, not if, the next market dislocation occurs, the 5-stage pattern will unfold again. The answers aren't in the future. They're written in the past. And the past says $54 trillion in derivatives doesn't stay theoretical forever.